Ark Invest just released their $3,000 price target for Tesla stock in the year of 2025, meaning they believe it can go 5x where it is today in just 5 years. Now, as an investor of Tesla myself with over 500,000 in Tesla stock, I look at this analysis and I want to put my own research, my own common sense, and go through it step by step with you. I also have found 3 problems that I think you should be aware of when you're looking at this kind of analysis. I'm the anonymous investor trying to be as transparent as possible, and to do that, not showing my face and identity. That way I can tell you how it is and have nothing to hold back, including my portfolio. So today we are up $24,974. Tesla stock was a pretty awesome gainer in today's market. The price actually closed at $670, but it was actually 38 cents away from hitting 700 today. So we had a bit of some volatility there. And overall, Tesla is one of my biggest holdings, 361,000 in this account, and then another 200,000 plus in my Robinhood account. I'm a big fan of Tesla, a big bull. I believe in Elon, his mission, and I think the company is poised in a place to take advantage with the next maybe 5 to 10 years of massive profit potential. They are in the lead and they're increasing their lead. So before I get into the 3 mistakes, let's go ahead and let's take a second to look at the Ark Invest analysis. It would do me a huge favor if you click like on this video for the algorithm. Click that notification bell if you want more videos from me. That'll let me know that you are actually interested in this content after you click subscribe there. I really appreciate it. Let's get into it. So there are plenty of amazing videos on YouTube about Ark Invest analysis. And if you haven't watched them, I just want to go through some of the biggest highlights. Even if you have, I think I can give you some important insights. So overall, bull case is 4,000, the price to be at $4,000. And the bear case to be at $1,500 in 2025. The percentages are 25% chance for the bear, 25 for the bull, and the expected value is somewhere in between as the analysis creates that graph. So here are some estimated values that they're using as plausible ideas for the bear and bull case out of their simulation. Now, the average selling price is an important metric. In 2020, 50,000, in 2025, 45,000, and in 2025, 36,000 with the bull case. The reason why the average selling price is higher for the bear case, bear meaning they expect less of the success of the company, bull case meaning they expect the company to outperform, is that with the increasing production of cars, the increased selling of the cars will have to have downward pressure. So the cars must have a cheaper and cheaper cost to them if they want to increase their volume. So they actually put the cheaper average selling price as their bull case, and that's because they're thinking of way more cars being sold, 10 million instead of 5. If you start getting to high volumes in the millions, you have to lower the price to satisfy the customers that aren't able to spend the increased amount of money. So this is one really important aspect of any business, right? What is the selling price of the car? How many cars are you selling? Now, besides the amount and the overall revenue, which this will help create, then the most important aspect is like how much are they actually keeping? And that's the total gross margin. So margin is at 21% now, with the bear case to jump to 43%, the bear case, and 50% for the bull case. I want you to keep these in mind. This is very important, the gross margin, because it doesn't matter how many cars you sell, it doesn't matter the price of the cars. What really matters for profitability is the profit margin of the car. So if you make $1,000 worth of sales, or let's say $100,000 worth of sales, this would incorporate $43,000 of that as profit. This would be $50,000 out of $100,000 in sales to be profit. So as we go down here, you can see the market cap in the billions. This is reverse engineered with a PE ratio, and the PE ratio is actually very conservative compared to where we're at now and compared to the tech stocks that we're seeing. And the PE ratio is maybe the most conservative aspect of all of this. Now, the PE ratio is one thing that, if you change the PE ratio, it's the way to reverse engineer the price of a stock based on the earnings per share. So we're really doing two things with this analysis. We're figuring out, okay, what do we think the expected success of the business could be in terms of the amount of sales and the amount of margin and the cost per vehicle and some of the other intricate aspects that have to do with the success and the overall sustainability of the business. And then there's the other part that goes, okay, how should that be translated into the dollar value of the stock? Now, the dollar value of the stock, they have a Monte Carlo simulation, which takes into account a ton of different data, creates a simulation with all these graphs. You can check it out by Googling Monte Carlo simulation. But here is the expected value of $3,000. Obviously, you can see things are rounded. It's not an expected value that the simulation will spit out of $3,122.16. It is an expected value. So there is some rounding here. And overall, I think this is an amazing place to look at what could be with Tesla stock. So now let's get into the problems. Now, the one thing that I pointed out here is the total margin. As we can see, the total margin is 21% now, jumping to 43% or doubling as the bear case scenario, meaning they think that's at the very low end of what could happen. That is very aggressive in my opinion. Now, the reason why the gross margin might be able to be vastly superior than any gross margin of other car companies, which are never able to achieve margins like this, would be because of full self-driving, which is an over-the-air update, essentially, that could be put into any car because it is just an update. So we're talking 95% types of margin for that increased value. So if full self-driving jumps to, say, $15,000, well, let's say 14,000 of that might be pure profit. So there is a huge potential for Tesla to increase its gross margin with full self-driving. Also, full self-driving might be or will be offered as a subscription in the near future. So think $200 or $300 a month, let's say, for a subscription to full self-driving to allow your car to drive itself. That is high profit revenue, extremely high profit revenue. Now, the other thing that might be a Tesla advantage with gross margin, which not a lot of people are talking about, is the manufacturing automation. Now, Elon has said that in the future, Tesla will be known for its manufacturing. Now, this is not a lot of what Tesla is credited for at the moment. Tesla has tons of robots in their factory, so many that they actually had to downsize the robots and add more human hands to it at some point. But with the way Elon's mind works, he is all about optimization, and he sent a letter out to employees saying, you know what is a great idea? A great idea might be something that saves a couple pennies. So if you have a great idea and you can save a couple pennies on each car, that is a great idea. This says two things. This says, one, that Elon is super focused on the cost. It's the biggest thing that bothers him the most about Tesla at the moment is he wants to be able to bring the cost down for the car. And to do that, you've got to bring the cost of the margin down. So you have to increase the profit margin. So that is one thing that he's very focused on the margins. But the second thing is that we know that there isn't huge gains that can be had individually. There's not going to be one thing that might be adding $10,000 worth of gross margin per vehicle without some sort of software element. Now, 43% is very aggressive, specifically because Elon has mentioned before that his goal target margin might be 30%. And if we know anything about Elon, we know that he really reaches for the stars. And the most amazing thing with him is he will reach as far as he can possibly imagine, and he will almost always get very close to that area. He's amazing at executing. However, I did mention Cathie Wood had a pretty conservative PE ratio, meaning the way to reverse engineer the price of the stock based on the profits of the company. Maybe this will help compensate for what I believe is very aggressive for a bear case scenario. And problem number two that I really want to focus on, and this is something in investing that is so important, and what that is it's very hard to know when. So we believe in Tesla, we truly believe in Tesla, but we don't know when it's going to be able to reach certain milestones. We don't know when full self-driving will be available. A few years ago, Elon said it was that year. Things are difficult to find in terms of narrowing in the time that something's going to happen. This is why day trading or even trading is pretty difficult to do. And that's why I am a long-term trader. It's much easier to invest in the long term than try to trade based on what the near future is, with the next month or 2 months or 3 months. It's very, very hard to identify that. So when you're doing leverage and trading and putting call options, you got to make sure that you probably protect yourself from some downside, because it's very, very hard to analyze things in the short term. So is it 2025 or is it 2024 or is it 2028? When you have exponential growth, meaning you have a growth curve that goes straight up, it's very hard to know when that's going to hit. A few setbacks will exponentially decrease the speed in which and the timing in which something gets rolled out. So that is the same with innovation, with exponential increasing. But as you have something that throws a wrench in the way, you're actually going to have an exponential decrease compared to the predicted forecast. A good example also of just seeing how hard it is to time something, look at Tesla stock in general. As Tesla IPO'd in 2012, you can see some pretty massive growth starting in 2013. And around this time, going from, let's say, $36 from, say, $6 with a 6x growth, I thought I missed my chance. And I had a connection that had actually invested around $1 million in Tesla at this time, turning his profits to around 5 million, which was pretty amazing. And I was blown away. I thought I missed out. And then for the next few years, nothing really seemed to happen super aggressively. Of course, there was some gains, and overall there were some gains. And I eventually bought in, I think around 2017, 2016, something like this. Nothing happened for a year, almost 2 years. Then things kind of went back down, and we're talking about a 20% gain in 3-4 years. And that's not too great. And I did not sell. I didn't believe I was too late. Instead, I realized, you know what, I'm just too early. And it's amazing what can happen if you hold on to something you believe in. Another example of thinking that maybe you're too late, but actually being too early, is Bitcoin, with the massive growth it had in 2018. And then the decline, and now, as we know, it is up around 5x what it was back then. It is very, very hard in the short term to identify when something can happen. So if you're relying on something happening at 2025 and something magically happening at that year, it's very, very, very difficult to predict. So all these predictions need to have a time to have any sort of relevancy. However, you should know that predicting things based on time is extremely hard. You can be too early and still be right. Now, the third thing is something kind of funny. The third thing with the problem with this is that it's not incorporating all of Tesla's business. So as we go down, we can see that it does incorporate a lot of Tesla's business: electric vehicles, the insurance business, the human-driven ride-hailing, which is, instead of Tesla going full self-driving and allowing all of its cars to basically act as Ubers without people in it, this is thought that as a stepping stone, perhaps Tesla is going to have human-driven ride-hailing, where Tesla owners can drive people as if it were their own Ubers. I don't believe Tesla is in the habit of taking measures that are kind of half-assed. And so only if there's a real value to Tesla will they do something like this. Tesla is not about going halfway just to fulfill the need of now. Instead, they're focused all on the future. So if this helps them make that stepstone and kind of solve some problems and understand the market better, then they'll do it. But if it doesn't, and if it's a bit of a distraction, they will definitely skip it, even if it has profit potential. Then there's the fully autonomous ride hailing, which we just were talking about. And if we scroll down here and we kind of go to the bottom, we get to the fun stuff. And what that is that we do not model Tesla's utility energy storage or solar business in our models. It's not included. Tesla's energy and solar business is not included. Elon has said that he believes that his energy and solar business will actually be perhaps the same size of his vehicle business with Tesla. And so if that were true, you might see a 2x kind of value from what we have in this Ark Invest analysis. Now, the energy and solar business will most likely, in my opinion, take longer to materialize than even their full self-driving capacity, which I think will happen on the later end of the year. This doesn't mean that all the cars are working without anyone in them, but it means the capacity is there to turn on. That's it for this video. Please subscribe if you haven't already. I really appreciate it. Most of the videos that I'll be doing are more on investing and the principles that I've used to create my portfolio and to have some pretty awesome success along the way. So I'm really excited to be here. Thanks so much for watching. Click the notification bar if you want to be notified on my next video, and I will talk to you soon. See ya.